Right now, banks are quietly changing what they care about. And this is happening faster than what a lot of people think. This isn't about politics, it's not about hype, it's about risk, income stability, and how banks protect themselves when the economy shifts. As a relationship banker, I'm seeing this behind the scenes live. And American Express is one of the prime examples of exactly how this is going down. Now, we're not looking to establish these relationships with American Express because it's going to make us rich. American Express has the credibility, and if we deep dive into a relationship with American Express, we get the exposure we need to build credibility with other financial institutions that have the tools and resources we need to build and expand our wealth. Does that make sense? So we don't want to get caught up in the hype of American Express. They're a great institution, they have great products, but at the end of the day, that's not the stopping point. They're not the end game. They're just another means towards the goal. So I'm going to give you my talking points that I have, my notes. We're going to be covering some really important shifts and changes going on in the economic system and how it's impacting American Express and how we're going to leverage the information we have to navigate these changes to make the most of our relationship with American Express. So one of the biggest points that we need to cover is how AI is reshaping jobs and incomes, making it more unpredictable for banks to assess where we stand when it comes to our income. Does that make sense? So essentially what's going on right now is it's creating instability, and one of the key markers that banks use to determine if they want to lend to us or not. And when this happens, banks do nothing but what they know how to do best, and they tighten up around consistency. So what does this look like? More job volatility, more contracts and gig income, less predictable cash flow. This is very important. This is what the AI disruption is doing to the space and forcing banks to realign how they assess us as clients and applicants. When income becomes uncertain, banks don't stop lending, they lend differently. They have to continue to bring in revenue, they have to lend out, but they're going to change how they lend and who they lend to. Very important. So why does Amex think differently? American Express has definitely created a different environment and landscape on how it does business and how it assesses clients. You got to keep in mind American Express is the foundational pillar to the charge card routes, right? We know American Express generally laid their foundation with credit cards from a charge card setup, a charge card product lineup. What that basically means is American Express is used to gauging income as the predominant factor, not necessarily credit. Charge cards, as we know, are designed for you to use and pay back on a monthly basis. So you technically shouldn't be using more than you spend. So in that case, you're not necessarily a borrower in the longer term sense of the word, but your income starts to trump your credit because your credit is needed for longer durations of time. In a 30-day window, I just need you to have the money that you fronted for your purchases. And so your income, this is ingrained in American Express's underwriting and how they view their clients. You also understand the no preset spending limits. So risk is managed dynamically, not statically. What does that mean in plain English? It means that they are monitoring the ongoing use case versus stats versus a fixed number or a fixed data point. They're looking at the ongoing behavior. This is one of the reasons American Express is so intense about making shifts like cutting limits out of the blue and monitoring risk. Your credit score drops, your spending inflates, you carry a balance too long, and they're watching the whole time. Now, your credit score might still be great. You might still end up paying that high balance off. But for American Express, they're looking for overall consistent behavior, markers, shifts, changes that indicate risk. Hopefully that makes sense. So they're not asking what your score is first. They're asking, can your income support what you actually use on the card? This goes back to that charge card route. Does that, so that basically ties in and says, yes, that American Express offers a litany of products that allow me to actually carry a balance, etc. But the root foundation of what American Express is built off of is going to be income driven. They're expecting you to pay these cards off in full. So what is this breakdown? How does American Express's trust formula kick in? Let's talk about that for a second. The first thing is income consistency, not just how much you make, but how predictable it is. Did you get a massive windfall that you don't know when the next bucket of that is going to come around? Did you get a big bonus at work? Or is this a consistent theme when it comes to your income? This predictability is going to be the deal breaker between a healthy, in-depth relationship with American Express, high-level approvals, and getting choked off with American Express. When you get in the door, you might get that first couple calls, some good limits, but all of a sudden you're at risk of getting your limits slashed. You're having a hard time getting new pre-approval offers. There's not other product offerings out there, etc. It's a big difference. Spend discipline. Patterns matter more than spikes. Lifestyle alignment. I talked about this in way back on videos. The data points that they're looking at that shows where you live, where you spend your money, what your income level is, all these different factors that they have access to. Do they make sense? Or is there incongruency? I talk about this a lot in the past, and I'm going to be talking about it going forward because, again, banks are getting more and more focused on internal dynamics, looking at the bigger picture of data that they are collecting themselves. If you're living in a poor zip code, but you're spending high money, you spend at these expensive places, but your income's down here, your credit report doesn't show you have more than a few $1,000s in exposure, nobody else has trusted you with high limits, you don't have mortgages on there showing that you own property, have the income to support that. There's so many data points that you might not be thinking about that's right in front of you and in front of American Express that indicates an alignment in your spend pattern and your other behaviors. So you have to keep this stuff in mind. This is why the hack game gets a cold shower real quick, because they give you all of these tactics to like get in with these institutions and even get some high limits. But then the incongruency starts to show over time. So you look good on the front end. They teach y'all a game for the first 90 days, but they don't tell you how to stay with them for 9 years. Big difference. Relationship depth. Yes, American Express cares about this. Time, behavior, product usage. American Express has launched an entire banking wing, checking account, savings account, CDs. They want an opportunity to start looking at more than just your spending behavior on the cards. That's a fixed set of data points right there. When I start offering you deposit products, now I'm getting to the cream of the crop, because now I have an opportunity to draw in a part of the relationship that tells me more about your income story without me having to necessarily request documentation on every application or take the risk of leaning on stated income. So they're offering the products and services to show inflows, outflows, savings, reserves. Now they're offering a full gamut of products. You have to tie in on this. So credit scores open the door, as I always say. Income and behavior decide how wide it opens. I say that time and time again, and it holds true in this conversation. So this is where the wealth gap quietly widens. I like to cover this in every video as much as I can at the broader picture. Predictable income gets rewarded first. What that basically means is those that are already in a stable or solid position are going to be the ones that benefit from an expansive relationship with American Express the most. They're going to be the first in line. And this is going to lead to them being able to capitalize on the opportunities, the features and benefits that come with the American Express relationship first. High credit limits, rewards points, access to 0% capital if you're going to be using and leveraging that. This comes to the people who are already stable and in a good position. Volatile income gets delayed. So I talked about it earlier. Contract work, gig work, 1099, solopreneur, ebbs and flows, seasonal peaks and valleys. Unfortunately, even though this is a part of doing business, unfortunately, institutions like American Express that are deep diving into the most intricate levels of data are going to be looking at this and they're going to be leery. Doesn't mean they're going to always say no, but maybe you get a $3,000 or $5,000 limit instead of a $15,000 or $25,000 limit. Maybe you only get approved for one card over the course of a year and a half versus having multiple offers every few months lined up for yourself to expand the relationship. It's a big difference in the access that you're going to get. So the next thing is going to be, this isn't about fairness. It's about risk, and risk is priced, how it's priced. This isn't about fairness. It's about risk and how it's priced. So what that essentially means is they're not looking at equity. They're not looking at an equitable playing field. At the end of the day, the dynamics are shifting around us. Stuff like AI is creating disruptions in income, which is directly impacting their business model and their clientele base. So at the end of the day, they have to price in those risk and mitigating factors. It is what it is. So if you were sitting across from me and asked me about American Express, this is what I'd tell you if you were my client one-to-one. Don't rush applications. Clean up cash flow optics, the appearance of your cash flow management. Match the product to income reality. So I may not jump out there and go get the Amex Platinum if I make $40,000 a year and I only have $300 a month in excess income. You can put whatever picture around that you want, but hopefully you catch my drift. I'm not necessarily saying $40,000 a year is a bad income, because if most of that is your take home, then you're doing great. But at the end of the day, it's important to understand, if I've got a card that's got spend requirements of, we want you to spend $12,000 in 3 to 6 months, and I barely have $400 a month in excess income, make it make sense. Let consistency work before leverage. What that basically means is going back to don't rush, going back to clean up cash flow optics. Show American Express you can manage what you have. Show American Express you can manage your cash flow. Show American Express you're responsible and prudent for a respectable duration of time. Not 60 days, 90 days. Banks work in quarterly cycles. Do great for 90 days and go run and get the bag. Please don't be that person. Don't be that guy. Don't be that short-term guy. Don't be that person. Think about it for a second and say, listen, if I'm looking to sustain a decades-long relationship with one of the greatest financial institutions in the country, maybe I need to show them a little bit more than 90 days of positive activity. I don't know. It's just a thought. So American Express rewards alignment, not urgency. They reward alignment, not urgency. Very important. So American Express isn't unique. They're just honest about what they value. This is very important. I'm not telling you this as like American Express has necessarily completely rewritten the game. They have their unique way of doing things, but they're just honest and transparent about what they value. So different banks respond to this environment differently. Some prioritize income, some prioritize assets, some prioritize data and behavior. And this is important because in a shifting economy, your banking relationships are no longer optional. They're a part of your financial infrastructure. Your banking relationships are no longer optional. They're a part of your financial infrastructure. So we need to break this down bank by bank. So if you want to understand how banks actually think, and not how they advertise, then subscribe. We're going to be breaking this down one financial institution at a time, helping you to master these financial institutions so you can make these relationships profitable and use these relationships to increase your net worth. Comment down below. Let me know what your experience with American Express is up to date as of 2026 at the time of this recording. I know a lot of my pioneers are familiar with me covering American Express. Year after year, I drop at least a couple of bangers around American Express. We need to now get up to speed in the current economic climate. So I want you guys to let me know, what is your current condition with American Express? Are you stagnant? Are you growing? Or have you noticed where they've been risked off with you? Have they been cutting limits? Have they not offered you any fresh approvals? Be honest and let me know how things have gone with you for American Express down below. To all my pioneers, welcome back. To my new viewers, welcome in. Until like, comment, share, subscribe, support the channel so the channel can continue to support you. Get in the description section down below. Time with me on Instagram and on TikTok. For those of you who are new, I'm an active banker and financial services professional. I have 14 plus years of experience. I have an active mortgage loan originator's license, active life insurance license, as well as a FINRA investment license, and I'm a small business banker as well. So you're getting this content from somebody who manages a client relationship book in just deposits of $25 million plus, not including investments, not including lending as well. So you're getting this from somebody who's helping take these kind of strategies and tactics and help clients in real life, small businesses, families, households, and individuals build and expand their wealth every single day. I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.